to today's LinkedIn Live event. My name is Dianne Crocker, and I'm the principal analyst here at LightBox, and I'm the host of today's event, Mapping Geopolitical and Market Uncertainty to Commercial Real Estate. This LinkedIn Live event is sponsored by LightBox. We are the world's leading property intelligence platform. We integrate real estate and location data solutions and facilitate industry connections with clients ranging from commercial real estate lenders, investors, brokers, engineers, technology companies, government agencies, and real estate developers. And our goal really is to empower competent, data-driven decisions across sectors. So today's topic, the commercial real estate industry really started the new year. It was firing on all cylinders. It was fueled by healthy property fundamentals, rising property prices. There was no shortage of debt and equity capital. And everyone I'm talking to is still drinking from the fire hose. The pace of deal making is fast and furious. But since the year started, market uncertainty has increased, not just due to the ongoing conflict in Ukraine, but we saw the first interest rate increases in 3 years. Inflation is a concern, rising construction costs. So we decided it was time to bring in the experts and help us kind of drill down and understand how market conditions are changing and think about what that might mean for our market through the rest of 2022 and give our attendees a flavor for things that they should be watching. So we hope today is a spirited conversation. We're going to run it at about 30 minutes because we know how busy everybody is. So without further ado, I want to introduce our 4 panelists who were really carefully selected to represent different segments of commercial real estate. So you should all come away with this with a broad perspective on how some of the factors that I just mentioned are really impacting investors, lenders, brokers at the ground level of our industry. So by way of introduction, I'm joined from LightBox's Carlsbad, California office by Tina Lichens. She is the Senior Vice President of our broker operations. Next is my go-to source for all things market related, Ryan Severino. Ryan is a frequent speaker at industry events, including our own PRISM conference a few years ago, and he is the senior economist at JLL. Third, we have David Scherer. He is the co-founder and Origin Investments. And last but not least, we have my friend Fred McDonald, who is a VP and appraisal analyst at Popular Bank in the New York, New Jersey area. So thank you all for being here. We're going to cover a lot of ground. So without further ado, I want to jump right in and let's talk about what the conflict in Ukraine could mean, because that's very, obviously very top of mind right now and very concerning. I'd like to hear your thoughts on the impact that the escalating conflict there might have on the commercial real estate market. So Ryan, why don't you go ahead and kick us off?
Thanks, Dianne, for having me. I would say that there are 2 main ways that I'm thinking about it. The first way is a little more indirect, and its impact on the overall economy. Obviously, the situation there is, I think everyone's aware of this, it's exacerbating inflation, which was already at an elevated level before Russia, went adventuring next door in Ukraine, to say it euphemistically. It's clearly exacerbating inflation. That has clearly rattled markets to an extent, I think, especially because it's caused the Fed to move a little bit more aggressively than they might otherwise have thought before this had started. So I really see it sort of through that mechanism, pushing inflation a little bit, consequently pushing interest rates maybe a little bit more aggressively than would have occurred otherwise, and potentially having some disruptive impact on the economy, which indirectly impacts the commercial real estate market here in the US. But the other way that I see it, which is sort of indirect, but approaching it from the other point of view, is that the situation in Europe puts the European economy and markets much more in the crosshairs, no pun intended, than the US market. And one of the things that we consistently see through multiple business cycles is that whenever there's a disruption somewhere else in the world, the United States is still the harbor in the tempest. We were already seeing a pullback on investment in China because of everything that's going on there. If we really start to see some concerns about the outlook for Europe and investment in Europe, it just increases the probability that capital flows into the US. And with real estate I think just objectively being in a favorable position in an environment with high inflation and rising interest rates, I think it actually could be in some ways a positive for real estate, even with some potential drag from inflation and higher interest rates.
Mm. Interesting. David, as the situation in Ukraine impacts energy, oil, supply chain for some materials, and of course, general market confidence, how do you see the situation in Ukraine impacting our markets or even specific asset classes?
Well, thanks, Diane. It's good to be here this afternoon. I actually agree primarily with Ryan. I would add that we've seen a flight to safety to the dollar. And so from an inflation standpoint, the dollar is so strong relative to other currencies, even relative to 2 months ago, that's actually going to offset inflation. But on a direct line, I agree with Ryan that higher oil, higher wheat, I mean, these are not nice to haves, these are need to have commodities. So that will result in higher inflation. It will be mitigated somewhat by a much stronger dollar. When you think about what foreign capital is buying, we know they're not buying bonds because our yield keeps going up. So that's not how they're getting in the dollars. They're getting in the dollars by buying hard assets, in my opinion. It's not happening through the stock market either. So short answer is I think there's more foreign capital coming in for the U.S. real estate market, but it's very selective. And what we've also seen, at Origin we only do apartments, primarily development, but really across the risk spectrum. We've seen a tremendous amount of consolidation in real estate. There used to be 5 vibrant real estate asset classes with some other subsidiary classes that were growing quite quickly, something like a self-storage or a triple net, or even towers, data centers. These are new categories, but you've seen a lot of consolidation really into 2, which is obviously multifamily and industrial. And we just aren't seeing the same capital flows in other asset classes. I can't speak that intelligently about other asset classes because, like I said, I only focus in multi. But I can tell you on the ground, we own 10,000 units, and we're constantly developing and owning, operating, and selling for certain funds. We manage funds. For example, our 3rd and 4th funds are in sell mode because it's the life cycle of those funds. So I can tell you we have 3 multifamily assets, all in strong markets. One is in Dallas, one's in Denver, one's in Atlanta, and they've all been sold post-Russian invasion. I don't know if that's the right term to use, but that's what it feels like to me. And certainly post the yield going from 1.5 to today, I think it sits around 2.75. I'm talking about the 10-year. And I would call that the risk-free rate. So massive move. Post the NASDAQ going down 20%, the S&P going down 10%. And so these are strange times. I can tell you that the buyer pool is thinned, for sure. In December, we would have had 15 to 20 buyers. Now it's more like 5 to 10. But in 2 of the 3 cases, we still have received outlier buyers, meaning at the high end or above the range of what we expected. So my opinion is in multifamily, you won't see appreciation this year like you did last year. It's going to flatten. It's unclear to me if you'll see a correction because rents are still growing so fast. And that's the ultimate mitigant. I think, Ryan, you would agree, any equation for a perpetuity is, NOI in our case, 1 plus G, WACC minus G. There's a lot of things going wrong, but G is still going up. That's pretty hard to combat from a valuation standpoint. If rents mitigate, if they stop going up 5, 6, 8, 10%, you're going to see cap rates go up.
Interesting. And multifamily is not a bad segment to be in right now. Let's move to interest rates then. So the Fed raised rates for the first time in 3 years. I've seen estimates that there could be 6 more to come this year, another 4 next year. So Tina, in response either to Ukraine or rising rates, are you seeing investors revising their expectations for 2022 in response?
Yes. And, it depends on the sector in which they're investing, of course. I want to go back to something that David said, because we're hearing the same thing from our broker clients in terms of the buyer pools being thin. And so, how do we think about, the likelihood that more capital flows into the U.S., into the safety of the U.S., into commercial real estate, yet, does that mean that there are more buyers sitting on the sidelines? Because what we're seeing and what we're hearing, I'll speak specifically about the office market. We have a client that has 400 million on the market in office in the Florida Southeast area. And he's telling us that, buyers, the number of buyers that they have is probably half of what they used to have. And that the offers that they're getting are about 20% less than what they were seeing earlier. So, obviously office is affected much more than multifamily, but, if we think about that, what does that mean for commercial real estate overall? And I will add to this that, we're seeing across the board since the beginning of the year, the number of individuals that are, digging deep into properties in terms of, executing agreements and starting due diligence is down about 30% from the beginning of January. This is just as of April. So, again, another kind of leading indicator of demand. Maybe they're making offers, maybe they're not, but there's certainly not as many people at the table.
That's interesting. Fred, what about you? You're in the trenches of the lending community. What are you hearing in terms of changes in the sentiment in the market?
Well, Tina said down 30%. We're up probably 20% between New York and Florida. And, we're trying to get a lifeline out there. So we're very busy. We are 20% above what we did last year. And that was an all-time high for us. And, we're in a very interesting space. We're in the, 5, 10, under $20 million space. And it's just, we do it predominantly multifamily, about 75%. And construction in New York, and then Florida, we do, quite a bit of, smaller, under 50 units. But it is just extremely busy. But we're also, with the interest in regards to the interest rates, our folks on the credit side and the lenders, we are very into debt service coverage. And if it's not a minimum of 120, which is usually, not, we're usually in the 130, 140 range, we just might take a pass on it. We are very conservative. Our underwriters are very conservative. They do they look at the long term, they look at the appraisal, and they'll look at it long term. But then they'll kind of gear, down to the 6 to 12 months, the last 6 to 12 months, which I think is very important. It's very nice that we see all these trends for 2 or 3 years, but the last 6 to 12 months are really, where it's, happening in terms of, rates and everything. And I think the impact to our borrowers right now, I've had several calls from our account officers. Everybody is saying we've got to get the appraisal in right away because we're under rate lock. And I'm like, God, I haven't heard those words for a while. And I feel even more pressure to make sure that my guys are getting this stuff done. So, rate locks are, very important to us, a very important item. The other thing that the borrowers are doing very much is looking at the expense side. They are just combing the expenses, because sometimes, the appraisal is so close that they're just saying, well, something's wrong, especially down in Florida. I've never seen it like this, where it is just everything's over ask. And it's just been an incredible run at this point so far, since last January,
Mm-hmm.
of 2021.
Interesting. Yeah, I talked to a lender in Chicago, and he echoed what you said, and the sentiment really was, let's get things done if rates are going to creep higher. So there is kind of this frenetic pace of lending because of that.
Yeah. Just on that just one last note, I'm predicting that we will do everything to try to close everything by October, at the latest November 15th, because they don't know. I mean, we've got the midterms coming up, and I'm sure, Ryan might mention something about those. I mean, but I think the closing of our deals in particular will happen, by October, latest November 15th. So.
All right. Well, you gave Ryan a seed. So, Ryan, what do you think? Midterm elections impact on the market?
I've been thinking a lot about this, and as somebody who, I pride myself on not being a political person, but obviously it's a huge component of how the economy functions, especially these days. My thought on this is, and I say this in a broader context, but certainly within the context of the election, when it comes to geopolitics, there really is an upside risk. There's really only downside risk, in the sense that things can go off the rails, and you've seen that manifest in multiple ways, both here domestically and around the world. My concern, I think, both with November and then ultimately in 2024, is that if 2020 is anything to go by, that even without transparency on what exactly is going to happen, because I'm not sure anybody has transparency on that, the risks are still slanted to the downside. And so that is what I find. I don't want to overstate it. I don't want to be alarmist, but it's definitely something that we have to take into account, because we've already seen this once before, and the probability that something at least as disruptive, if not more disruptive, occurs either with the midterms, or I think even more likely with the next presidential election. Clearly, that is now a feature, not I think a bug of the system, and we're going to have to contend with that, whether we want to or not, unfortunately.
Mm-hmm. Yeah. All right. So David, Tina, and Fred all brought up multifamily. The story in industrial, I think, is well told, but I want to just jump to office, because that's one element of commercial real estate where I think the future is probably the most nebulous. Ryan, I want to draw attention to your latest paper that I saw recently, where you talked about the segment of the office sector that's drawing outsized demand. Could you comment on where opportunities are surfacing in the office sector and where you think that's headed?
Sure. And I think, to be fair, some of these trends existed before the pandemic. And I think the pandemic, if anything, has been, at least an accelerant, if not something that has actually emphasized these trends. But there is clearly a preference for quality in the office sector. And I think that gets lost in the conversation of people who are just painting with a very broad brush. I mean, I could even go a little more finite and talk about some geographical differences, but that nationally is where the conversation is. There is a huge rift, and we're already seeing this in the data, between the performance of new buildings, say those constructed within the last 5 years, and those that were constructed prior to the last 5 years. And I think that is going to be a durable feature on the other side of this. I don't think that the pandemic is the death knell for office completely. I still think most people want to be back in an office at least part of the time, even if they don't want to do 5 days per week, and they don't always want to deal with somewhat onerous commutes that they had before this. And the office using segments of the economy are going to continue to be the driving force of the economy in the 21st century. So that will also create a lot of jobs that traditionally utilized office space. But I do think where the world is going to be different on the other side of this is that inferior, if not obsolete space, the rift between, the kind of sexy, shiny new space that's really in demand and everything else is going to widen out over time. And that has consequences not just for new construction, but certainly what it means for some of that older inventory and whether or not it gets raised and repurposed or converted eventually into entirely new office space at some point. So I think that's where, I feel pretty confident in saying that this isn't the death knell for the office market, but it is going to look different on the other side of whenever this pandemic is ultimately over.
Mm-hmm.
So Ryan, let me just add or ask you a question then. I'll tell you my perspective. I think office needs to reprice. There's a demand segment that's permanently gone. Zoom and Teams have taken over a demand segment for office, and I can guarantee you Microsoft doesn't intend to let it go. They're going to continue to iterate and improve, and it's low cost, and you've lost 10% of your demand, 5, pick a number. There's enormous operating leverage in office, and so you take 5% away and you actually have crushed valuations. But I'm listening to you, Ryan, and as an investor, I'm not in office, but if I was, what you're saying is you can't buy a new office building either, because what you just said is there's a bifurcation between bright and shiny new, and after 5 or 6 years, you're out of that league. Now you're in the commoditized, slug it out, $20 a square foot league. That's a terrible proposition in an asset class that you and I both know the cash flows that come through it are way lower than the reported cap rates after you pay brokerage and TIs and everything else. It's historically, it's a facade. Like you think you're going to get yield and you don't. I just think it needs to reprice. It's not dead, but it's certainly dead at the old pricing. And by the way, there are people who make money. Don't get me wrong. Fulton Market in Chicago is a new market, and everyone in that market has made money. But that's idiosyncratic to the market. I'm talking about, we're having a global conversation. Office cap rates, per your own dialectic, I mean, they don't work. Bright and shiny becomes commodity in 5 years.
Yeah, what will be interesting in the future is seeing where that inflection point is, right? How long does it take? Because I think what's happened in the last 5 years is that there's been a shift in, I don't want to say the design of the space, but the kind of space, the way that we utilize space relative to, say, the median office building that was built in Manhattan in 1957 or something like that. So the question then becomes, does the duration, the time it takes to become sort of inferior or obsolete, does that differ now relative to what the world was like before then? Because there is a clear break point there between how buildings are built now with a lot of interior light and better sight lines and not as many columns and the way that it's configured versus some of those old buildings. And I think that will be interesting to see how it plays out if that stays in vogue for a while, or if there's going to be a shift at some point. But I think a lot of that older inventory, I was already working with clients who weren't sure what to do about that before the pandemic. I think the pandemic is not making life easier for them, as maybe the most polite way that I can phrase that.
Yeah.
We've seen over the last 10 years, 12 years, every single contrarian strategy. We're going to buy retail because it's a value relative to the growth markets, multifamily, industrial, haven't worked. All of them. Hotels, retail. I'm going to pose today offices at the very early innings of that new secular move. You're going to see less demand, period, forever, basically. And there's two things that are going to cause it. It's not just labor that's mobile now and can work from home and it's accepted. That's part of it. The other part of it is we were dealing with automation before that. We were losing, AI doesn't need office space. It needs data centers. And so like you have all of this secular problem against an industry. And, there's a great Warren Buffett quote. I think we all know it. If you put a great management team against the wrong industry, it's the industry that leaves with its reputation intact. That's a fact. You could have been the most average data center manager, owner, industrial manager, owner over the last 10 years, and you killed it. And you were average the whole time. That's the new paradigm we're in, and I think office is in inning one of that, being on the wrong side of that.
Yeah. Well,
yeah, and I think that's where that inferior inventory, like that is where I think it really is. That is where I think you're going to see the most shakeout in the business. It's not going to be with Fulton Market. It's not going to be with Manhattan West or Hudson Yards. It's not going to be One Vanderbilt. It's not going to be JP Morgan's new building in Midtown Manhattan. It's going to be with a lot of that older space that was considered if not, like I said, inferior, if not completely obsolete before this. I think that's where you're going to see, I think, a lot of the shakeout in the office market over the next 10, 15 years.
Yeah, and we'll see that in retail, as real estate evolves and assets change to in response to the market's need. I want to hit on two more topics because we're getting close to the half hour. And the first is on pricing. So David had referenced, at least in multifamily, his expectation that we won't see a lot of price appreciation there this year. The latest Real Capital Analytics report noted that, and this was across asset classes, a slowdown in the annualized rate of price increases in the first quarter of this year. So I'd love to hear thoughts on that. Is that a red flag, or is it just kind of a return to normal after rapid upticks post-pandemic? Who wants to kick us off? Fred, you want to jump in?
Sure. I think the pricing is, and I'm going to give Florida as an example. The rent growth there has not stopped. I mean, especially at least the multifamily that we've done, and even some of the shopping centers. And I think it will keep going throughout at least this year. I mean, after this year, anybody's bet. But cap rates are still very, very low. I mean, we're getting into I've had a couple in the 4s in Florida, which is really kind of getting me nervous, but we'll deal with that. But I think Florida, because there's such an influx of people from the United States, or coming from New York and all around the country, and they're just doing deals like crazy. I mean, like I said, we're up 20% overall. And I heard that we've got, a couple dozen deals in the pipeline that we haven't touched yet. And, so I think it's all positive. And, we're a little bit over a $10 billion bank. I mean, it's, a solid size, but there are other banks out there, but there is I think a lot of upside, but I'm cautiously optimistic.
What about geographic hotspots? You mentioned Florida, and I know a number of MSAs down there on the list of hot metros post-pandemic. Other smaller ones that have seen population increases, like Charlotte, like Austin, even Dallas. What other metros do you think are on investors' wish lists? This is open to anybody who wants to jump in. What geographic trends are we seeing?
I'll jump in. Fred, we're really active in Florida, Orlando, Tampa, Jacksonville. We have 2,000 units in development we own. To answer your question, Diane, we're all over the Sun Belt, whether it's the Southeast, Texas, the Southwest. Phoenix is still, in our machine learning AI, one of the top 3 markets. Austin is still one of the top 3 markets. Tampa Bay scores incredibly high. But I will say that, and I agree with you, Fred, that the rent growth is still there, and the appreciation is still there, because, I did a webinar this morning for our investors that the reality is you can raise interest expense and you can raise building costs and you can raise cap rates, but when you have 10% rent growth, it doesn't matter. You've still created more value than you've destroyed. And so asset values are going up. I don't think that's sustainable. And it's simply because, and by the way, our own machine learning corroborates this. We predict strong rent growth throughout 2022, and then it tapers off, and then it really tapers off in 2024. And if you think about it, rather than get into the data and the math, it's all about affordability ratios. Rents are going up faster than wages. It's not sustainable. And, the people that rent aren't the millionaires moving from Manhattan to Florida, okay? These are people that, they need to be somewhere between 25 to 35% of income in rent, and they're getting stretched. And it's just math. You can't raise rents 10% a year forever. Historical rent growth is 2.5% to 3%. I mean, that's what it is in real estate. We're in unprecedented times. The Federal Reserve has done a lot of things that I don't even disagree with, but they've changed the equations, and we're seeing that in asset pricing and in a lot of ways. and now they're undoing it, right? And so we have to be responsible about how we underwrite and how we talk about real estate. It's supposed to produce a 5 to 7% dividend and 3 to 5% appreciation, a hard asset. That's what it's supposed to be.
Yeah, and you really nailed an important point here, which is one that Fred brought up too, and that's the numbers matter now more than anything. With all the uncertainty, with price increases possibly leveling out over the next few years, it becomes that much more important in underwriting to make sure that the numbers check out, that the assumptions about rent increases are accurate. That's taken. Okay, let's start with I want to question to briefly, what do you think that we can expect to see as the rest of 2022 plays out? We'll start with you, Tina.
Sure. So, I mean, there's no slowdown to activity in terms of, product coming on the market. Every asset class, obviously, we're seeing more multifamily and industrial and, leased of office, but we had our record number of listings come to market on the RCM LightBox platform last week than we've had in the 21-year history of the business, and we're not seeing any signs of slowdown. But it has to, right? At some point, it has to. And so, based on what we're hearing, and Fred, I think I'm with you. I think by late Q3 at the latest, I would expect us to see some changes. Maybe things hold out through the rest of the year, but certainly things look different next year at this time.
Ryan, what do you think? How's this year going to play out? What are you watching? What might worry you?
I think it's better than I think most people think. I think a lot of the narrative right now is being colored disproportionately by inflation. And it's hard to do this, but if you ignored inflation temporarily and looked at almost every other metric in the economy, you would say that the economy would have to be in a spectacular place. GDP growth, the labor market, cost of capital, it's just this one factor is having an inordinate impact. I don't think it's going to stay at these uncomfortable levels permanently. It's going to take a while to decelerate, but inflation is very spiky. It runs up and it comes back down. And if it does that the way it's done throughout the entirety of recorded economic history, and the rest of the economic environment generally holds the way that I think it can, I think people will feel better about the situation than they do right now, where one specific component of the economy is overriding all of the other positives that are going on right now.
So that's reassuring. How about you, David? How do you see the rest of the year playing out?
Real estate is a basket of commodities. When you own a building, you own lumber, you own concrete, you own rebar, you own copper. That's one of the reasons existing real estate is going up in value. Importantly, if you have a real estate asset in demand, one of the mistakes investors make a lot is they say, I want to buy this office building because it's 50% below replacement cost. Totally irrelevant if there's not enough demand. Irrelevant. It's only relevant if you have demand, right? Then replacement cost matters. I like real estate in demand that is a basket of commodities. That's good. In terms of where we're heading, I think that by Q3 and Q4 this year, you're going to see a correction in all real estate, even the stuff in demand, including multifamily, including industrial. And the story I'll tell is Blackstone. Pull up Blackstone stock today. They're having record earnings last quarter, record earnings the quarter before. But you know what? The market is a forward-looking entity. It's what it's doing. It's looking into the future. And I think by Q3, the market's going to look into the future and say, I don't think industrial rent can go up 10% every year. I think it's going to normalize. And you're going to see, and even if inflation ebbs, it's still, the risk-free rate's higher. So as you try to look at these equations for the forward-looking market, I think we'll have a correction. It's not going to be severe. And the beautiful thing about real estate is it does go up over time. It's an amazing asset class. You can depreciate it. You can own it. 10 years from now, it'll be much, much higher. You have dividends throughout. The sky is falling, but I believe there's a correction. It's coming. And that's a healthy thing. You know what isn't healthy? What happened in Florida in '09? I was there. I'm old enough. I was buying stuff at $40 a square foot. Okay, let's not act like Florida only goes up. That's a myth.
Yeah, and maybe the first quarter pricing data that I referenced earlier is an early sign of that normalization. Okay, Fred, so you kind of showed your hand when you said that you were going to be up 20% this year, but let's hear your final thoughts and what you expect to see through the rest of 2022.
Okay. Now I'm going to come back up to the New York area. The impact on higher interest rates will affect multifamily that's under rent regulation, because the expenses, like David mentioned, they're going up. So, they've got to be watched. Unregulated though, apartments will be fine. I mean, because they can charge whatever the market can bear. But I think just one general thought, we touch very little on like lumber and oil prices. And if we've got to watch expenses. And David was 100% right. If you don't watch expenses, you're really going to, really be in for a bad surprise. And I'm constantly doing that. Being on the due diligence side, my account officers don't like, to hear it, but it's like, we've got to be careful. So.
Yeah, for sure. Okay, well, thank you so much, Tina, David, Ryan, Fred, for being here. Maybe we'll reconvene later this year and see how close you were to your predictions for the year. For those listening, if you haven't seen it yet, take a look at our latest investor sentiment report. It covers a lot of the same topics that we just addressed here. It's on our LightBox website, and there's also a link to it in the comments. To our audience, thank you for tuning in, and we hope to have you all on a future LightBox event. Have a great rest of the day, everybody. Thanks so much.
Okay, thanks.
Thanks,
David,
Dan.
Tina, it was nice meeting you. Ryan, Dianne.